Good morning, everyone. On behalf of ICICI Securities, I welcome you all to Crompton Greaves Consumers Electricals Limited results call. Today we have with us Mr. Promeet Ghosh, Managing Director and Chief Executive Officer, Mr. Rangarajan Sriram, Managing Director, Butterfly Gandhimathi Appliances Limited, Mr. Kaleeswaran Arunachalam, Chief Financial Officer, Mr. Yashwant Rege, Vice President Strategy and FPA, Ms. Natasha Kedia, Head of Investor Relations. Over to you, Mr. Ghosh.
Yeah, thank you. Do we have everyone that, or are we still waiting for someone? Can we get started? Okay, good. Thanks firstly, ISEC for hosting this call. As already been said, I've got Sriram, Kalesh, Natasha, and Yashwant with me. Thank you everyone for joining our Q2 earnings call. What I'm planning to do is to take you through some comments, and then we can get into the Q&A. You have most probably already seen the presentation that we put up. I'm not necessarily just tracking the presentation because I want to make a few more detailed comments, which I hope will be useful to give color. And then we can take it from there. Firstly, macroeconomic environment. The environment is still challenging. And discretionary purchases have been softer than anticipated as a result of inflationary pressures and lower than anticipated consumer confidence. However, from September 23 onwards, we did see an uptick in consumer sentiment, which we hope will sustain in this coming festive season. Unseasonal weather conditions and regulatory changes further added to the volatile demand environment, which impacted channel inventory and pricing actions. These pressures have had an impact on overall margins, but the efforts of premiumization, mix improvement, cost optimization helped partially offset that impact. Inflation continues to be a concern, and FY24 inflation, as you know, is forecast about 1.5%. An expected slowdown in inflation, we expect will help bolster volume growth. And having said that, we hope there are better times ahead with inflation trend now. Insofar as the board is concerned, as you are also already aware, at the end of his second term, Mr. Hemant Nerurkar, who was our chairman for 7 years, superannuated and has therefore stepped down from the board. Mr. Sundaram, who's also been on the board since the beginning, since 2015 when the company became listed, has assumed the chair of the company. He will be relinquishing his position as the head of the audit chair, again a position he's held for a long time, and he will be replaced by Ramesh, who was a former head of Deloitte, as you are probably aware, now recently joined as a council board of L&T. He's going to become the new audit chair. Mr. Sundaram becomes the chair of the organization. He, as you are also aware, was the CFO of HUL for many years and now also serves on the board of TVS Capital Funds. He's also been on the boards of several companies, SBI General Insurance, GSK, and Trent. We are also very delighted to welcome 2 new board members in line with our tradition of having a very individuals particularly noted for their achievements in their respective fields. We've had 2 more people who have joined. Anil Chaudhary has joined as an independent director. Anil was the MD of Schneider Electric India Private Limited. This was the entity that acquired L&T Switchgear some years ago. So Anil was the first CEO of the combined entity and was quite instrumental in transforming that combined entity, which is, of course, the largest switchgear company by some distance in India. He has 4-decade-long experience in energy automation and infrastructure. Also has keen interest in sustainability, energy efficiency, and diversity. Sanjeev Kakkar, again, they're quite well known. He has had a 38-year long career with Unilever. He was a member of the executive board of HUL before he moved on to head the very large Unilever business of which spanned the Middle East, Russia, Ukraine, Turkey, Middle East, North Africa, as well as Central Asia. And that's what he did until he retired. So we're delighted to have them on board, and also a note of gratitude to Mr. Heyman, who stewarded us for many years. Insofar as Crompton 2.0 is concerned, we've embarked on the 2.0 journey, Crompton, and there are several key elements to that. Premiumization, go-to-market excellence, brand investments, and new product development and innovation. Insofar as premiumization is concerned, we improved our premium finance saliency to about 28%, which is about 0.5% higher than it was the previous year. Executed some very successful product launches, making us the player with the largest range of premium BLDC fans in the industry. And obviously that's showing up in the numbers, but this is kind of the detailing that's gone into the numbers, so to say. We deployed a new brand architecture in pumps, added variants such as Shield and Smart Series under our mini category, and in lighting, we have also actually improved our premium saliency, which is now on about 12%, having improved about 1 percentage point. It's worth noting that we have been growing both our traditional go-to-market channels, which is general trade, as well as some pretty strong growth in alternate channels. So we doubled our e-commerce business over the previous year. This quarter, it's now more than 100 crores per quarter. Hopefully that growth momentum will actually sustain even in the future. This growth is attributed to our expanded product portfolio selection, enhanced product availability, increased investments in digital marketing. Our alternate channel saliency, this is basically everything other than GT, general trade, has improved to 17% from what used to be about 13% in Q2 FY23. We also crossed the 2,500 mark level in retail transformation in terms of Crompton branding with our direct channel partners. We continue to make consistent investments in brand building, which has led to an increase in brand saliency across categories. In Q2, we launched a high-impact campaign for mixers and grinders. Hopefully some of you have seen that, which has garnered a high share of voice. The campaign, Secret of Fine Taste, witnessed a 40% increase in reach on a year-on-year basis. Multiple content assets were deployed in other categories as well. 6 new influencer videos with 3.8 plus subscribers, garnering 1 lakh plus views in fans, in small domestic appliances, we had 15 influencers with 8 million plus subscribers and 3.5 lakh plus views. All of these obviously are going to help me further build our alternate channel reach. We continue to drive digital discoverability. Our always on fan campaign garnered 70% SOV versus competition of 50% share of voice. We also launched a seasonal water heaters campaign. Overall, our ad spends in A&P spends actually grew 31% year-on-year, in line with seasonal trends and in line with what we talked about in the past. And we implemented focused initiatives to increase awareness, consideration, and preference across categories and channels. Now, insofar as the financial numbers are concerned, we delivered a industry-leading growth of 17% YOY in ECD segment, due to a strong momentum in both fans as well as small domestic appliances. The pumps registered a growth of 10%, led significantly by agri also beginning to fire at about 17%. In lighting, where competition remained taut with industry-level challenges due to price erosion and B2C, margins improved on account of cost optimization measures and product mix. Lighting EBIT margins improved by 250 basis points with an absolute EBIT growth of 16% YOY. We've talked about building our lighting business so that we have a right to win. We've made a bunch of changes, as you're aware, on the lighting side, to revive growth there. But in the interim, as that begins to fire, we are building up very strongly the profitability, which gives us the right to grow in that business. And some of that you'll see flowing into growth in the future. For Butterfly, retail and modern trade continue to grow amidst what was the industry-wide demand slowdown. There was a shift in festive season. The festive season is later this year, approximately a month, I think, to Q3 as compared to last year. So there's a little bit of a impact of that that's happening. Last year resulted in pre-season buying moving to Q3, as we talk about Butterfly in greater detail in a moment. Segmental performance, let me first take fans. In ceiling fans, again, some of the emphasis that we had on premiumization is beginning to bear fruit. I told you about the improvement in premium saliency. The premium segment grew by 30% plus in the last year-on-year, which was the standout growth driver. TPW fans, which is, I guess you would know, is table, pedestal, and wall fans, is growing faster than the category, with the high-speed segment within TPW leading the growth. Laddering actions that we took, coupled with new launches, boosted our presence in this premium segment. We've achieved a milestone by beginning to manufacture the sub-economy segment in-house. That should help, obviously give us greater control of our manufacturing, but also help improve the cost structure as we go forward. We undertook actually pricing actions, despite the competitive nature of the market. We took pricing increases. Can't say a lot of our competitors followed, but moderate, but we took pricing increases, showing our intent on protecting margins. in the last quarter, and we'll see how that goes. Maybe we'll take some more in the future. We are really driving premiumization across the board, with embedding that into various parts of our go-to-market and various parts of our demand generation mechanisms. Right? We are also focused on reducing costs. As you are aware, the BE transition, which happened earlier in the calendar year, has had some impact. Not all of which, the industry is being able to pass on to the segment. But, we are working quite diligently on trying to mitigate those impacts as we go forward. Insofar as appliances is concerned, and this appliances includes both what we call the large domestic appliances as well as the small domestic appliances is concerned. As you are aware, we segregated those two segments internally from a reporting point of view. And appliances overall grew about 17%, driven by both the underlying segments. Kitchen appliances maintains a robust growth, propelled by mixer grinders, where we've introduced a 750-watt mixer recently. That's helping quite a bit. And the kettle category, which is getting doubled over the last year. We are also, we are empowering an on-the-ground feet on street approach to sales in small domestic appliances. And really, it's all about, frankly, taking a slightly different approach to small domestic appliances, and that with considerably more feet on street, training, reviews, etc. And that is showing up in how our small domestic appliances is growing, which, as I said earlier, has been one of the drivers of growth for ECD overall. Water heaters and coolers, which is large domestic appliances, the growth in the segment was backed by really water heaters doing extremely well for us. And the last quarter, we sold the largest number of water heaters that we ever had, which is in excess of about 10 lakh units. Frankly, that translated into pretty significant 10+% market share gain. Not market share gain, 10+% market share in the water heater segment, combined with market share gains. Insofar as our pumps is concerned, I noted earlier that we've got, as you're aware, we've got pumps both now in the agri as well as the residential segment. Residential segment is an area that we have a significant market share in, close to 30%. Now our pumps growth was further bolstered by about 17% growth in the agri sector, particularly in the and we also saw growth in the residential submersible segment. We in fact, actually in the resi segment, I think we can disclose that also grew about 20% year-on-year. We've come out with a new brand architecture in the mini segment, which is the largest part of our residential segment, and we've seen a volume growth there quite well as well. Quality improvement actions in resi submersibles and focus on panel sales also help grow. We sell panels, and now we have a significantly improved attachment ratio where the pumps that we sell now much larger number of those pumps also have our own panels which are attached to the pump segment, to the pumps that we sell, but needless to say, adds to margin, adds to growth. Insofar as our large kitchen appliances business is concerned, this is a business that we are incubating, and there we are seeing growth being driven by channel expansion and a material increase in EBOs that are a particular channel that we are experimenting with in selling our large kitchen appliances. So there was an improvement in EBO productivity and an expansion in modern retail. The revenue run rate for the quarter climbed to about 5 crores per month versus about 2 crores in the previous month. There is an improved traction that we are seeing in homes, where already we've introduced the Wave 2 model, and that's translating into recent growth there. We are working on rolling out a 360-degree marketing initiative to drive awareness and store the footfalls. This was also the quarter where we opened the 75th signature store for selling large kitchen appliances. Now coming to lighting. Overall, the lighting segment declined about 11% year-on-year as industry challenges loomed, particularly in bulbs, patterns, and even now in the ceiling light segment a little bit in the B2C part of the business. There was a price erosion that we saw happening, particularly in patterns and lamps. We are working apart from the go-to-market, which we've talked about a little bit in the past as well, with the structural changes that we introduced early in the quarter. We are also working on a strategic sourcing and manufacturing strategy that will further bolster our capability in this segment. We, however, witnessed some early signs of recovery in the B2B side of the business with flattish demand. Focus continues on growing distribution, like I've already noted, leveraging both traditional channels as well as now strengthening our modern trade and e-commerce in the lighting segment as well. We are working on building a comprehensive portfolio with focus on ceiling lights, and there's some new introduction in that segment, which some of you may have noted already see, and there's a few more which are expected to be introduced in that segment on short order. And the new sales structure that we talked about was implemented from the 1st of September, and we think that will help the go-to-market, which has been a challenge in the B2C segment earlier. EBIT margin in lighting improved from 10.5 to 10.5%. From 8.5%. And there was despite the growth challenges, there was an EBIT growth of 16% year-on-year. Like I said earlier, as we work towards strengthening our go-to-market in lighting, we are simultaneously working diligently on strengthening the right to win in this segment. And that is showing up in our margins, but we believe that these margins will help quite a bit in the journey going forward when we have the GTM also fall into place. Before next is Butterfly, as you will be aware, we had initiated the process of amalgamation of Butterfly with Crompton, and that process, while it received 3/4 of majority in terms of equity shareholders, did not pass the majority of minority vote. and therefore that the amalgamation has been withdrawn. The respective decision of the public shareholders, and we believe the valuers had offered a very fair valuation for that was fair to both Butterfly as well as to Crompton shareholders, being the other stewards of both the sets of shareholders. And having said that, if the shareholder turn it down, we fully respect that. We continue, of course, to be the controlling majority shareholder at Butterfly with a 75% shareholding. And we do believe that our process of realizing synergies, both on the revenue side, control side, leveraging the two strengths leveraging the strengths of the two organizations, those will continue unabated while the legal structure of the two companies continues, and they are standalone because they are in the interest of the shareholders. And that's the way that we've approached the business so far, and that's the way that we will continue to approach it in the future. Overall, insofar as Q2 FY24 performance of Butterfly is concerned, revenue of 308 crores, decline of 16% due to festive season shift and one-off corporate sales in Q2 FY23. Modern retail and modern trade channels continue to grow despite demand slowdown. Specifically in the Kerala region, the growth was boosted by Onam activities. During the quarter, several activities were conducted to drive customer engagement and reinvigorate the channel. EBITDA was at 25 crores with a margin of 8.2%, which investments in people, capabilities, and brand building. We anticipate an uptick in demand in Q3 with a shift in the festive season. Consolidated performance, consolidated revenue growth of, this is for all of Butterfly, revenue growth of 5%. This is, we said, has moderated because of Butterfly's degrowth and driven by industry-leading growth in ECD, which was at 17% YOY. We have material margins at 31.3%, EBITDA margins at 9.8%, and this was down about 1.6%, partly due to lower material margins and higher investments in brand and capacity building. PAT declined by about 13% for Q2 FY24, excluding one-off tax adjustment. As you might recall, there's tax adjustments that we tax write backs because we got tax refunds in the previous quarter. Standalone PAT was a decline on a like-for-like basis for Q2 and would be at 5. The decline on standalone basis would be about 5.6%, excluding one-offs. During the quarter, we paid out 192 crores of dividend. The net debt stood at 61 crores versus 145 crores as of 30th June 2023, the end of the previous quarter. And this is, as we said, is on account of the dividend that we paid out. Conclusions, we have materially streamlined the business post the strategic review, which we've been talking about, that we conducted during my earlier years. We continue to take the right actions, I hope, to transform the business into a growth-oriented organization which is profit-led and delivers strong TSRs. We are focused on our core categories of fans, pumps, large appliances, and small appliances, and have demonstrated a success in the large kitchen appliances category, which we entered about a year ago. And that's early stage days yet, but again, we are seeing a new business being incubated there. While through Butterfly, we also obviously are endeavoring to win in the kitchen appliances business. And as you can see, the growth in our small domestic appliances business, which is also essentially kitchen appliances, continues to be very robust. In fact, one of the drivers of the ECD growth of 17% that we reported this year. We think our kitchen appliances business, kitchen foray, is on track. At the same time, we're developing a long-term strategic manufacturing and supply chain footprint, which will support our emboldened aspirations, and also working on go-to-market excellence, apart from brand, greater emphasis on building our brand, which is already very strong. Our focus continues to be on building our innovation capabilities, intrinsically led by consumer needs, and our portfolio transformation efforts in addition to delivering on operational priorities. You've already seen, I talked about a little bit about how the premiumization journey has so far panned out. Hopefully we'll remain on that track solidly going forward. And with that, I will pause. Thank you for listening. We are obviously open to Q&A, and we'll have the rest of the team now also speak a little bit, because I'm sure you're kind of bored of my talking all this time. So, all right, guys.
Yeah, thank you, sir. Aniruddha Joshi here. Thanks for detailed presentation. Now we will open the floor for question and answer session. Any participant who wants to ask question, please raise your hand. Participants can unmute their line and go ahead by announcing their company name and with the questions. First, we have a question from Renu Baid. Please go ahead with your question.
Yeah, hi, good morning, team. My first question, I have 3 questions here. First, can you just summarize the overall demand momentum in the B2C segment? You did mention that optimism was seen through September, and you expect this to be maintained through festive. So are the B2C or consumer offtake headwinds which were witnessed over the last 9 to 12 months, you think they are broadly behind? And any more color in terms of any regional color in terms of offtake or segments would be helpful here.
Renu, just let me quickly calibrate. When we say B2C, we usually mean B2C lighting. So I'll clarify that this is there's very little B2B business in the rest of our categories. But
as in my question is broadly on the consumer demand and offtake.
I understand. So I just want to clarify first before I answer.
Yeah.
So yes, consumer demand continues to be moderate. This is not a market segment where we are seeing strong boosted consumer demand. Now, that may be because of inflation. It may be because whatever, people are not spending as much. There are a whole bunch of reasons. Frankly, I don't think anybody in the market quite understands why this may be exactly so. Having said that, what we have done in order for us to keep ahead of it is to simultaneously also strengthen our premiumization journey, right? And strengthen our position in not only developing the go-to-market, the traditional GT, what we call general trade, but developing our e-commerce and rural platforms as well. And that is the reason why you're seeing the kind of growth that you've seen in recent times. So yeah, I can't say I'm seeing a strong revival in consumer demand yet. Yes, there is some uptick that we are seeing because of festive season, but that's a seasonal uptick that you see every year. It's a little later this year than it is every year.
Got it. Second question on the fans and ECDs, where fans has come back very strongly with respect to volume growth, while most of the other peers are still grappling from a higher base and slower offtake in the market. So this kind of volume growth, do we think should be broadly sustainable over the second half? And incrementally moving, how do we look at the share of premiumization in the fans portfolio over the next 12-18 months?
Baba, insofar as higher base is concerned, I don't think our base was low last year.
Absolutely.
So I don't want to get into that. Kalish, you want to answer?
Yeah, sure. I think, first and foremost, as you know, we don't want to give a forward guidance in terms of what we are trying to achieve in the coming quarters. See, as we talked about, we are looking at an opportunity to grow fans category across various elements. Fundamentally, one is premiumization. Maybe compared to the industry, our share of premium to the portfolio is probably on the lower side. So there is enough headroom available for us to grow on that segment and drive, which is something that we have been consistently executing on ground, and we are starting to see results of that when it comes to premium fans. We also believe there are categories within fans like the table, pedestal, and the wall category, which is an opportunity that has not been tapped by us. We have started actions around it, and we are seeing good amount of growth coming in from that also. Coming to the core fans, which is our value segment that we operate in, there we do see it is something that we will move along with the industry trend. I don't think so we would be differentiated from there. Wherever there are opportunities on distribution and penetration, we continue to address on that. That's on the brand product side. Channels also tend to play a very, very strong role in this, as Pramit was earlier referring. We do see consumer preferences are now slowly moving away from general trade, and it is becoming dot-based into channels like e-commerce, channels like modern trade and RCS. Our execution opportunity remains very, very high in those areas also. A combination of these 4 or 5 initiatives, we think there is good headroom available for us to look at the future in terms of how fans as a category can do.
Sure. And
insofar as channels are concerned, it's a very interesting thing. You know, our understanding is that a large number of people who look at fans on the e-commerce space eventually go and buy the fan of the GT on general trade. So you know, fortunately we have the strengths that we have on GT. Now we are building up our strengths on the e-commerce as well. The reverse is much more difficult to do, as you might imagine. So we kind of filling in some of the gaps perhaps that we'd had in the past. Yeah.
Shortly. And just last question, while the Butterfly demerger is now called off, can you help quantify the targeted savings, both in terms of the net savings, probably in terms of cost and revenues that you were expecting for the parent company Crompton? And I know getting earnings accretion is could be even challenging in fiscal 25 demand looks so. But how is the way forward in terms of synergies coming in from Butterfly?
Yeah. See, one of the things when we called out as part of Crompton 2.0 is we have been very good in identifying savings that are above gross margin via the Unnati program that we have now been consistently driving for about 5-6 years. What Butterfly gave us an opportunity is to look at our cost below gross margin. So we talked about the entire pool of indirect costs, which we have about, say, 800 crores sitting in there, which is what we shared when we announced the Crompton 2.0 strategy also. We think Crompton and Butterfly coming together in this area, there is good headroom for us to look at 7-8-10% cost reduction on that base, which should start evolving as we close this fiscal and move into early next fiscal. Now, largely, we think there are opportunities in warehousing and logistics. There are opportunities in after-sales service, etc., that we're looking at. So all those things continues to stay. We don't think any of those things were tied into a legal merger. And also to give you a little bit more color, from the time of Butterfly acquisition to now, there were two tracks that were running in parallel. One is an operational integration of Butterfly with Crompton, in spite of a legal merger that we need to do. And in the last 6 months, when we announced the intention to merge the company, we opened up a legal track also. So the operational integration track continues. That also prima facie focuses on the revenue and cost synergies that we need to get together for both the organizations and both the shareholders, which we don't think so will get significantly hampered by the merger not going through.
Got it. Thanks much, and yeah.
Thank you.
Thank you. Yeah.
Thanks.
Thanks. Thanks, Renu. Participants are requested to restrict their questions to just one, and then you can join the question queue again. Next, we have a question from Mr. Keyur Pandya. Please unmute your line and go ahead with your question. Thanks.
Thanks for the opportunity. The question is on the ECD sales. So the kind of growth that we have seen with the other players, now versus the growth we have seen in Crompton. So is this in line with secondary or tertiary sales, or this is more of stocking for the channel? Just want to understand this. And in second half of previous year, I think the company's commentary was that the company did not push the non-rated fans. In that context, should we outperform in second half also versus the industry? Thank you.
So, Keyur, as we said, we don't want to provide a forward guidance on what would our second half be. We continue to strive and do the things that we talked about for each of the categories we talked about earlier. Let it be fans, appliances, pumps, or kitchen for that matter, including lighting. Now, as far as the channel is concerned, you would see that the growths are divided into two buckets. Our alternate channels have outperformed significantly, and these are largely consumer offtake driven channels like a modern trade, a regional chain store, or for that matter, e-commerce, which is phenomenally almost we doubled our business in e-commerce as compared to the same time last quarter. So I don't think so there is a stocking that comes in here. GT works in line with the market. It is not that you need to look at a significant fill-in that happens. We have been following the market trend as it happens, and we are already seeing good festive momentum happening in October. Let's see how does that move forward and we close the quarter for Q3.
Fair enough. Just one follow-up on this. So basically, there is nothing abnormal in this growth, as you mentioned. Just the breakup of GT, modern retail, and e-commerce, either for ECD or for the company level as a whole. Any broad numbers for this breakup?
We don't give a channel-wide split, Keyur. We would see that maybe we are going at say 2x in alternate channels compared to our GT business.
Understood. Last and second question is on the raw material side. Now, have we seen the worst in terms of raw material? Now it is up to the company whether the benefits are passed on or retained. But directionally, should we see things improving as far as profitability is concerned? Based on just raw material as well as improving mix. Thank you. And
raw material and?
So raw material getting favorable and improving mix towards premium. Should we assume that profitability should improve?
See, fundamental strategy that we talked about in Crompton 2.0 stays, which is as an organization, we want to drive growth by reinvesting back into business towards marketing, innovation, and people. That should provide us a sustainable revenue growth and a sustainable margin model for us. Keeping that as the base, the way we would look at this on the two questions that you have raised, one is on the raw material prices. Interestingly, the categories that we operate in, while there is a commodity play into it, there is a lot of regulatory impact that comes in. Let it be the regulatory changes that we are seeing in fans or the changes that we have to go through in geysers, etc. in the past. It means that post BEE transition, while the commodity super cycle is over and it is moving into a stabilization mode, the cost increase that we had to absorb on account of BEE rating is yet to be fully passed on. And we think as a market leader, it is important that apart from the cost actions, we also need to take price actions. That's where you have seen us doing one round of price increase already in the month of September. As the demand scenario develops through festive and we get better clarity, we may have to look at couple of price actions further in the coming quarters also, beyond the other cost benefits that we need to see where it is. So in a nutshell, the way we need to look at it is at what level our ECD portfolio margin needs to stand at. And we think structurally there is a headroom to improve on account of the regulatory cost increases being recovered either through price or cost action that needs to be done. Beyond that, we want to focus on investing behind the brand and drive growth. That's where we would look at it. Yes, obviously premiumization will help us in driving share of profits. The profit pool with premiumization is always higher at an absolute level as you compare to a non-premium category. But also you need to keep in mind that a premium category is going to be innovation-led, and that is a consumer innovation-led, which also gives us an opportunity to invest behind the brand to take the brand to the next level. So it will be a calibrated call as to how do we balance growth and profitability and ensure that the absolute profit growth comes in.
Understood. Thanks a lot and all the best. Happy Diwali.
Yeah, thanks. Now next we have question from Rohit Gajare. Please go ahead with your question. Thanks.
Hi, are you able to hear me?
Yes.
Yeah. Thanks for the opportunity. This is Rahul Gajare. So I have one question on your built-in appliances. You've in this particular quarter, you did report an EBITDA loss of 6.5 crore rupees on a revenue of 14 crore rupees. Could you give us a sense on the total EBITDA loss that you have done in the first half? Because if I see your, if I were to adjust for this, your other business is not as bad as what it appears, because of this loss. So some financial numbers on this will be helpful. And connected with this, while you're in the midst of transitioning, to Crompton 2.0, could you also highlight, if you have plans, in the built-in appliances to add more product category in this specific basket? Thank you.
So, Rahul, allow me to state by saying results are always comparative in market, and good or bad does not happen by what you choose to do in one category. With that, I think total losses that we have incurred at H1 level on a built-in kitchen is about 14 crores. Structurally, the gross margin of this business is in line with what we do in other ECD categories. So the unit economics are being built in a strong manner. It is also important that we invest behind this business to get the penetration up over a period of time. It's also a funnel approach where you get your customers through a combination of organic and inorganic route, which means it is at a size where you don't want to do too much on brand awareness, but you need to calibrate how much you want to spend behind the brand also, which is where you see the upfront investments that we need to make into the business is going towards losses, which we think will continue for few more quarters before the scale helps it to start making money as a product category and channel. Now, in terms of the overall product additions that we can do into the entire built-in kitchen, I think we're looking at two-pronged approach. One is how can we first improve the touch points even before getting into the product. The channel opportunity, as we talked earlier, we've already opened a 75th exclusive signature store. What we also need to keep in mind is do not see built-in kitchen appliance as a standalone business of Crompton. Look at an opportunity for Crompton to start commanding and selling premium products to the consumer, right? Prior to having this entire category operated, it would have been very difficult for a consumer to relate to a brand like Crompton selling a product that is upwards of 20,000, 25,000. Now, probably we are moving towards one of the fastest to hit an annual run rate of 100 crores in this segment. That also means consumer acceptance that states that as to premiumization as a strategy that we are working up resonates extremely well with the market. So that's the second benefit that we're trying to get in. Third, outside the EBOs, we're also looking at touch points within modern trades and RCS for the category to expand and grow. That's on the channel side. On the product side, yes, within the category that we are playing in built-in kitchen itself, we are looking at new initiatives to come in. It will be a combination of refreshing the product portfolio of what we are having today with better features and adding in few new subcategories also within the built-in kitchen space.
Yeah, to answer that fundamentally to your question, Rahul, the answer is yes, we are incubating a new business for good reason. We believe that has contributed to 14 crore EBITDA loss in the first quarter. Needless to say, the profitability of the rest of the businesses is what it is, excluding those 14 crores, right? And we think it's a good investment to make.
Sure.
Yeah, thank you. Next, we have questions from Abhilasha Satale. Please go ahead with your question. Thank you.
Yeah, thank you for giving me opportunity. My question is on ECD margin outlook. So, as you have mentioned that the lower margin is largely because of the channel mix change and that is what is impacted up to large extent. Going forward, how do we see our channel mix? Like, do we see this 2 times growth in alternate channel to continue and therefore, we might face margin pressure in the near term and then improve thereon? How do we see our near-term margin outlook and long-term? And secondly, if I just exclude this channel mix, whatever the impact on the margin for GT channels, are our margins same what we were making previously, or there also we have seen some kind of erosion?
Abhilasha, allow me the opportunity to correct you. Channel mix has got nothing to do with ECD margins coming down. ECD margins is largely on account of structural shift in the product cost of fans, which is due to the BEE regulatory changes that has been brought in. So that has led to incremental input cost that we need to factor in to make a fan that is star rated, which was introduced from 1st of January. So we are in the process of figuring out what is the optimal level of price and cost decrease, price increase and cost decrease we need to work upon to restore our ECD margins over a period of time. So as we cross over some of these milestones in the respective quarterly meetings, we'll call out how the progress has been made on this.
So, Abhilasha, we've been doing this for a while, right?
Yeah.
That we've worked quite hard at dealing with cost pressures quite successfully, particularly at the gross margin level. There was a bit of a step change because of the BE transition, and we are in the process of being able to recover that through internal cost actions as well as through price increases, which we talked about. It's not related to a change in GT versus other channel mix.
Okay. So, sir, actually you mentioned that, there is a room for improvement. So by when can we say whatever the initiatives we are taking and because of the premiumization increasing in the overall portfolio, by when are we expecting, that margin impact to get nullified and improvement in the margin?
I don't want to give a forward-looking number there, Abhilasha, but I mean, I think it's fair to say that we are actively engaged in this process. And over a period of time, we talked about Project Unnati, for instance. We've been reasonably successful in, neutralizing pricing, neutralizing costs increases. So I'm not going. But if to your question earlier about whether we hope to continue to step up our the alternate channel, yes, absolutely. We have a strength in GT, and we're going to continue to step up our alternate channel reach.
Okay.
Thank you. Next, we have a question from Mr. Ajit Motwani. Please go ahead with your question. Thanks.
Ajit, you're on mute.
Yeah. Are you able to hear me now?
Please go ahead. Yes.
Yeah. Okay. So one is the question on the regulatory cost that you highlighted, that the B ratings had impacted the regulatory cost and, that sort of nullifying the benefits of commodity. So as you know, it's been more than 6 months that these things came in. So what would have been the price increases, or let's say the net impact that you are yet to recover from regulatory cost increases? And as far as small domestic appliances and fans are concerned, how is the festive season started for us, if you can highlight?
We couldn't get the second question, Ajay. Could you repeat, please?
I'm saying, as far as the small domestic appliances are concerned, mixer grinders, water heaters, as well as the fans category, how has the festive season started for us?
Okay. So, first and foremost, on the margin side, when we moved into the entire PWE transition, roughly the cost increase was about, say, 15% on account of the energy rating transition that we need to meet up with. About 8-9% of that has been met with the cost decreases and the value engineering work that has been done. Industry as a whole, as you would remember, early in last Q3, everybody called out for a price increase that will be taken in the range of 5-6% effective January post the energy rating. But as we have seen the demand scenario that it has panned out in the last 2-3 quarters, it has been pretty difficult to do any kind of pricing actions. Either many organizations have rolled it back, or held back the entire price increases that they have taken. Now, as we move forward, probably 2 to 3 quarters down from the entire PWE rating, we believe from a unit economics perspective, we need to balance both price and cost increase. So we had announced roughly about a 1% price increase to 1.5% across the portfolio in the month of September. That has factored in. We are now also working upon further cost decreases that we can do via the Unnati program that we're working upon. And outside that, it might warrant 1 or 2 more price increases also, which we are open to take it up to get the margins restored. In terms of festive demand, October has been positive. We could see there has been an uptick in terms of October's momentum, but we will see that more as the quarter gets completed as to how does it pan out.
Okay. So, if you can highlight, I'm not talking specifically October, but right, let's say few months, July, August, September.
Ajay, as we said, let's restrict it to one question per head, because otherwise, we've got another 5 minutes, we will not be able to get through most of the questions.
Yeah. Got it.
Please help Natasha for any other questions that you've got here.
Yeah, thank you. We have one question on chat box from Mr. Bhavin Vitlani. I will read out. Could you please help with breakup of ECD divisions, absolute revenue numbers for Q2 and H1, and YOY growth for A, fans, pumps and appliances, and B, breakup of appliances into water heater, mixers and air coolers? Thanks.
We'll ask Natasha to share the data by portfolio, and that might be helpful for.
To the extent that we discussed, just please connect with Natasha for those details. Yeah. If there are any comments that you'd like from Kalish or me, just please shoot.
Yeah. So next we have a question from Mr. Siddharth Bera. Please go ahead with your question. Thanks.
Yeah. Hi, sir. Thanks for the opportunity. Sir, so what I understood is that there is a 3 to 4% under recovery in the costs, like you have mentioned, where we need to do some more price increase or cost reduction. So after doing this, in some time, what is the margin level we aspire to go back to? Will it be closer to 16, or it can be higher than that, given that we had delivered even better margins in the past?
So, I think, Siddharth, fundamentally, as you have rightly pointed out, we talked about the action that we are going to work upon continuously on the fan segment to improve the margin and how do we need to recover it. See, end of the day, when it comes to EBIT margin delivery, we need to look at Crompton as an organization needs to deliver revenue growth, and that is fundamental. And therefore, it is extremely important that we balance our revenue growth versus our profitability growth. Which is where we said the revenue growth is not at the cost of price or cost actions. It's going to be investment behind the brand. And we need to have innovation. So we talked about premiumization as a driver. We have talked about progress that has been made in fans as a category on the premium growth. Now, this is coming in only with interventions being made with products that are coming in from our tech center, with consumer insights and not only led by competitive intensity. Second, it also means that that product that is going into the market needs to be backed by stronger brand communication. That's why if you see it, H1 as a whole, our marketing spends have gone up by 50%, 50. So that's a significant amount that has been put behind the brand to drive the growth engine up. So we don't want to get into a near-term EBIT or a EBIT margin guidance. As we talked about, we are conscious of the fact that we need to grow the business and deliver profit growth than a profitability expansion. But in the journey of profit and profitability, structural unit economics would not be left behind, which is why we are reiterating that in spite of the growth agenda that we are working upon, we need to restore our margins and fats via the cost or the price action that we need to take. So these are two different sets of action that will be taken. You will see cost and price actions to help to improve the ECD margin profile. At the same point of time, we want to take that as a fuel to reinvest behind the brand and continue growth momentum for many more quarters to come. That's how we wanted to balance our portfolio approach on both growth and profitability.
Got it, sir. So, but given the strong...
Thank you. Next, we have question from Utkarsh Mehrotra. Please go ahead with your question. Thanks.
Sorry, I got cut off, but
Yeah.
Yeah, thanks for the opportunity. This is Utkarsh from Schonfeld. Just one question, sir. In terms of the price hikes that you've taken, has the competition followed? And then since that you're planning a couple of more price hikes, because to your point, given the industry dynamics on demand, do you think they would follow? And if they don't, then would you roll back? Thanks.
No, so, I think the price increases that we've taken are an indication of, they're modest price increases, but an indication of the approach that we want to take. And look, at the end of the day, it's a mix of how we're going to approach this. So it's all about intent, right? What we're saying is that we want to continue to grow, but we also want to protect our margins. And we are the leaders in the market. So you'll see a mix of this playing out in the market, whether other competitors will follow or not, we'll see. But look, you want to do what's the right thing for your business, right?
Got it. Thank you.
Yeah, we have last question from Mr. Rahul Agarwal. Please go ahead with your question.
Hi, am I audible?
Yeah.
Thank you. Thanks for the opportunity. Just one question on the manufacturing side of it. I think you talked about some changes there. Could you elaborate a bit on fans, appliances, pumps, and B2C lighting? What are the changes should we expect over the next 12 months on manufacturing from Crompton Greaves?
Yeah, Rahul, I think we announced earlier that we are currently in the process of creating a strategic sourcing footprint, whether that be from own manufacturing or from outsource. So that's still under preparation, and we will come back to you when it's possible for us to disclose it to the market. Having said that, we are, insofar as fans is concerned, on a journey of more in-housing, particularly of our seat category, because that is something that will lead to cost savings, greater manufacturing facility, and needless to say, other strategic benefits. So that is already continuing apace. That you can expect will be expanded in the next few quarters, right? What that will do is not only greater in-housing, but step up the capacity utilization of our own units, right? Hopefully that will also go towards improving our margins. That's a part of the journey there. Okay? So, but insofar as the rest of the businesses are concerned, it's work in progress is what I'd say. Today, our footprint is that about 50-50 in fans between what we do in-house and what we outsource. Insofar as small domestic appliances is concerned, it's largely outsourced. Insofar as lighting is concerned, largely B2C is insourced. B2C and B2B is largely insourced currently. And we'll see how this go. And obviously the idea would be what maximizes margins, what maximizes strategic benefits for us. Yeah.
Okay. Thank you.
Yeah. Thank you. On behalf of ICICI Securities, we thank the management for the conference call, and now I hand over to the management for closing comments. Thanks, and over to you, sir.
Well, thank you, everyone. Wishing you a very, very happy Diwali. We'll connect in the next earnings call. Thank you.
Thank you.
Thank you. Happy Diwali.
Thank you.